Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. Okay, so at this point we have noted scenario number 1 when talking about testing for impairment for fixed assets. Now we're going to talk about scenarios 2 and 3, which will consist of testing for impairment for all intangible assets other than goodwill. Right, as we mentioned, goodwill is this scenario number 4, which will have its own separate set of criteria. So still thinking about Moreno's pale ale distribution. And as we said, due to some unforeseen regulations, they are not going to be able to generate as much cash flow from these fixed assets and these intangible assets as they once thought. All right, so Moreno's has 2 important intangible assets to consider when testing for impairment. As we mentioned, they built their own machinery in-house. Okay, so when building that machinery, they slapped this patent on it. Okay, so they also have the Moreno's logo to consider. So both of these are intangible assets, although one has a finite life and the other has an indefinite life. Okay, so let's say that the patent on the machinery is a 10-year patent. So that means that the life of the patent will expire, so it needs to be amortized. Whereas the logo is considered an indefinite life intangible asset. Okay, so there is no expiration to this logo. So what you need to know for the exam is that these are 2 types of situations to consider when it comes to intangible assets. So we need to understand the key differences in our intangible assets and how they are going to be treated for financial reporting purposes. All right, so limited life and indefinite life intangible assets are what we are focusing on. All right, but we also have goodwill. When previously talking about intangible assets, we discussed how they are going to get recorded if purchased versus internally generated. Okay, so if the intangible asset is purchased, it is always going to get capitalized. All right, so we're going to capitalize goodwill at the fair market value, aka the purchase price. Okay, but that's if it's purchased. If it is internally generated, we're going to expense the intangible asset, regardless of whether it has an indefinite life or a limited life. No expense will be incurred related to goodwill. Okay, so we're going to amortize limited life assets, which makes sense because we wouldn't amortize an indefinite life intangible asset. By definition, they're never going to expire, right? They're going to live on forever. So no need to amortize this as it won't have a useful life. Okay, so no amortization related to goodwill either. When we talk about limited life versus indefinite life intangible assets, what we're going to see is that limited life intangible assets will be a 2-step approach. We're first going to test for recoverability, then we're going to apply the fair market value test. When it comes to indefinite life intangible assets, we're only going to apply the fair market value test, which is a 1-step approach. Okay, so when we get into goodwill, we're going to talk about how this is tested by using a reportable unit test. All right, so now that we've been reminded how we're going to record intangible assets themselves and whether or not we're going to amortize them, let's dig into this last category, which is testing for impairment a little bit further. Okay, so we want to know how we're going to test for impairment for both of these assets. If the intangible asset has a finite life, right, thinking about the patent on that manufacturing machinery, and let's say that it has a 10-year patent, then nothing is changing from what we talked about when testing for impairment for fixed assets. We still have this 2-step approach. All right, so this is going to be the exact same. So in the first step, we're going to compare the undiscounted future cash flows to the net carrying value. Okay, so if the patent is expected to generate cash flows that is less than the carrying value, then we know that an impairment loss is going to exist. Okay, so in step 2, we're now going to calculate the actual impairment loss. And again, we need to determine whether or not it is held for use or held for sale. Very similar calculation, we're still just comparing the net carrying value to the fair value. Only if the intangible asset is held for sale, we're also going to include the cost of disposal. All right, and that's if it has a finite life. But if the asset has an indefinite life, right, talking about Moreno's logo, that is never going to expire. So we actually now only have a one-step approach, meaning we're skipping step 1 when testing for whether or not impairment actually exists. We're going straight to step 2. And if we think about this intuitively, the reason is because there is no need to compare the undiscounted future cash flows, right? And that's because this is not entirely determinable, right? Technically, by definition, if it's going to last forever, it will hold value forever. All right, so that means that no need to actually determine if impairment losses exist for indefinite life intangible assets. We're just going to go ahead and assume that they do. So simply just going to determine the impairment loss calculation by taking the net carrying value and comparing it to the fair value. And again, if it's held for sale, we're just going to include the cost to sell. Okay, so super high level recap of these first 3 scenarios. They're all virtually the exact same, with the exception of intangible assets with an indefinite life. The only tweak here is that we're not going to be applying that step 1 when determining if the impairment loss exists. All right, this is very straightforward stuff, people. Okay, so going through another couple of quick examples related to testing for impairment. Only now we're testing for impairment for intangible assets. Very similar stuff going on here from what we talked about when we were testing for impairment for property, plant, and equipment. Only now we're seeing that Moreno's Pale Ale distribution has a patent on its machinery with a 10-year estimated useful life. Okay, so right out of the gate, we see that this is an intangible asset with a finite life. Okay, so due to unforeseen circumstances, the value of the machinery and patent have recently experienced a significant decrease in overall value. So the related financial information as it pertains to the patent is as follows. Okay, so the patent had an original cost of $120,000. It had accumulated amortization of $50,000. We have undiscounted net future cash inflows of $45,000 and a fair value of $40,000. Okay, so because we know that this has a finite life, we're going to be incorporating both steps 1 and 2. Okay, so step 1 is determining whether or not an impairment loss even exists. And we're going to do this in the same way that we would make this determination if this was a fixed asset, meaning we're going to take the undiscounted future cash flows and compare it to the carrying value. Right, we're asking ourselves, is this asset going to generate us more cash flow in the future than its current carrying value? All right, let's find out. So the first step is determining what the undiscounted future cash flows is. This is $45,000. All right, we know that the patent has a $120,000 original cost, but it has accumulated amortization of $50,000. So that means the carrying value is $70,000. All right, so this is what's getting compared to the future cash flows that are undiscounted. And the reality is that a potential impairment loss will exist. Okay, so this is no bueno. So this is not going to generate Moreno's more cash flow than the current carrying value. All right, so we've now determined that a potential impairment loss exists. We now move on into step 2, which is comparing that same carrying value of $70,000 to the asset's fair value of $40,000. So the impairment loss that we're going to record is $30,000. Okay, so next example, very similar, only now we see that this is a logo that we're talking about with an indefinite useful life. Okay, so very similar information. The original cost is $120,000, accumulated amortization $50,000. Now we see that the undiscounted future cash inflows is $75,000, and we have a fair value of $40,000. Okay, so this one's actually a little bit tricky. Your immediate response might be to apply the undiscounted future cash flows to the net carrying value to first determine if a potential impairment loss exists. And if we did that, we would see that no impairment loss would exist because the $75,000 undiscounted future cash flows exceeds the carrying value. All right, so we're not going to make less money than the carrying value, but this intangible asset has an indefinite useful life. So it doesn't matter. We're going to still test for impairment under step 2. Okay, so we're going to still compare the asset's fair value to the carrying value to calculate that same $30,000 impairment loss. Had this been an intangible asset with a finite life, the answer here would be 0. There would be no impairment loss. But we're bypassing step 1 if we're calculating impairment losses for intangible assets with an indefinite life.